Okay, good morning, afternoon, evening. Today I want to talk about another dodgy financial institution. Previously, I've pointed out about how COMEX and the LME were claiming server outages and other garbage so they could manipulate the silver market. Well, this time it's Nasdaq, and it affects a lot of people because anyone who's got investments directly or via their managed funds in Nasdaq 100 ETFs like QQQ, QQQM, or any fund that has investments in the Nasdaq 100. And this is why. On the 1st of May 2026, Nasdaq quietly changed the rules governing how newly listed companies enter its flagship index. The change is called fast entry provision. Sounds structural, sounds pretty dull, but what Friar wants to make the case for today is that it's one of the most consequential structural changes to passive investing in years. And it, funnily enough, arrives just in time for the biggest IPO in financial history. Friar's definitely not buying SpaceX. He's definitely not buying any IPO at these multiples. But what we need to understand, the mechanism, because it affects positions we already hold. We'll start with the 5 things that we need to understand before going into detail. Nasdaq changed its index inclusion rules on the 1st of May. The fast entry provision cuts the waiting period from 3 to 12 months down to just 15 trading days. This forces ETF managers tracking the Nasdaq 100 to buy SpaceX within 15 days of listing, at whatever price the market has set. Estimates range from 22 billion to 60 billion plus in forced purchases. Doesn't sound right, does it? SpaceX is targeting a 1.75 trillion valuation on $15 to $16 billion of revenue. That is a triple-digit price-sales ratio. Meta Platforms has $200 billion in revenue and is currently valued at $1.45 trillion. Think about that. There is a structural conflict of interest here. Nasdaq changed its own rules as a marketing play to win the SpaceX listing over the New York Stock Exchange. The beneficiaries are insiders, venture capital holders, the Wall Street underwriters. The party bearing the risk is the passive punter. So obviously Friar's doctrine, no entry, no defined risk structure justified at these multiples. Quite absurd, as we will go into. So let's be precise about the mechanism, because precision matters here. Under the old rules, even a company worth hundreds of billions could not be included in the Nasdaq 100 for at least 3 months after listing, sometimes up to a year. That seasoning period existed for a very good reason. It allowed price discovery. It gave the market time to absorb information, for short sellers to operate, for institutional analysts to probe the prospectus, as well as private analysts to check on what the institutional analysts come up with. They are sometimes biased. Overall, this is the stabilization mechanism. Now, the new fast entry rule, effective as at the start of May, compresses that entirely. Under the new framework, Eligibility is assessed as early as the 7th trading day after IPO. Formal inclusion can occur within 15 trading days. The 10% minimum free float requirement has been eliminated. Fast entry inclusions do not require an existing constituent to be dropped. The index can temporarily exceed 100 members. That last point is important. It means there is no offsetting sale to finance the purchase. ETF managers must buy new shares with fresh cash from their tracking funds. To understand the scale, as of December 2025, approximately $527 billion in assets across 63 ETFs were tracking the Nasdaq 100. BlackRock and State Street have both filed new Nasdaq 100 tracking ETFs, which will only increase this figure. All of that passive capital must mechanically buy SpaceX at whatever price the market sets on listing day. And I've included some references there for anyone that might be that way inclined. It's a good way to be inclined. Okay, let's look at the SpaceX valuation numbers. Friar wants to be fair to SpaceX as a business. It is genuinely extraordinary. Starlink has 10.3 million subscribers across the globe. It does a great job to get internet to punters that are well away from cities, like in Australia, to the stations, etc. The launch cadence is without parallel. But beware, extraordinary businesses can still be bad investments at the wrong price. The numbers as of the official filing. Target IPO valuation, 1.75 trillion. Planned fundraise, 75 billion. Nearly 3 times the previous record set by Saudi's Aramco, $29 billion IPO in 2019. Estimated 2026 revenue, 15 to 16 billion. Some institutional estimates reach 24 billion. Wonder why they have done that. So we'll be generous and use that that number. Implied price by sales ratio, even at 24 billion revenue, this implies a price sales revenue multiple, of 73 times. At 15 to 16 billion revenue, that figure exceeds 100 times. So if we put that in context, Meta Platforms is a cash-generating machine with 200 billion in revenue, enormous network effects and proven earnings power. Currently trades at $1.4 trillion valuation. SpaceX is asking for more. Saudi Aramco at IPO had 330 billion in revenue and a price sales of 6 times. Nvidia, perhaps the closest in terms of transformational technology premium, trades at roughly 25 times sales. Triple price sales ratios have a consistent historical record. Every game-changing technology has endured a bubble-bursting event. The internet, genomics, clean energy, electric vehicles, crypto. SpaceX is not exempt from the laws of financial gravity simply because the technology is genuinely impressive. A key risk is the XAI merger, completed in an all-stock transaction just prior to the IPO. Bundles a pre-profitability AI venture into the listing. Investors acquiring SpaceX have no structural protection against SpaceX profits being used to subsidize XAI's compute expenditure. It's not good. Now this slide's critical. Punters need to realise that when they buy SpaceX or QQQ Holdings force you to hold SpaceX, you're not buying a rocket company, you are buying three businesses consolidated under Elon Musk's singular governance with no ring fencing between them. Business 1, Starlink. This is a genuine cash cow. Recurring subscription revenue from 10.3 million subscribers and growing. Near monopoly in commercial low Earth orbit broadband. Increasing penetration into direct-to-cell markets. If SpaceX were simply a Starlink play, the conversation would be different. Still expensive, but at least the cash flow mechanics are visible. Business 2, the rocket business. Inherently capital intensive, Starship development is not free. Launch cadence growth requires manufacturing investment. Subject to production delays, inflation on material costs, and the ever-present possibility of a high-profile failure that resets the narrative. And business 3, XAI. This was acquired via an all-stock deal immediately before the IPO filing. XAI is pre-profitability. It burns significant compute capital. Elon Musk has characterized it as a vertically integrated innovation engine. But that is promotional language, better known as bullshit, for we have not yet worked out how to make this pay. The critical governance risk. There is no legal obligation for Musk to ring-fence Starlink's cash flows from XAI's expenditure. The IPO prospectus will need careful reading on this point. Until we have that clarity, an XAI drag is an unqualified liability sitting inside a triple-digit price sales multiple. So who benefits and who bears the risk? This is always the right question in financial markets, and it is particularly pointed here because Nasdaq appears to have changed its own rules to win a commercial listing. The beneficiaries are clear. SpaceX founders and early venture capital. They crystallize at peak valuation before price discovery has occurred. Elon Musk personally. His net worth will be consolidated at the $1 trillion level. The underwriting syndicate's a good word. Goldman Sachs, Morgan Stanley, Bank of America, Citi, and JP Morgan. Crime syndicate. Sounds like the five families. Are all joint book runners on a $75 billion raise. The fees on this transaction alone will be historic. Next, the Nasdaq Group. They won the listings over New York Stock Exchange by offering guaranteed fast-track index inclusion as an inducement. Institutional IPO allocatees, they receive shares at IPO price and benefit immediately when 22 to 60 billion of forced ETF buying arrives within 15 days. The parties that bear the risk, every holder of QQQ or QQQM, forced exposure, no opt-out at hype-driven pricing. Pension funds, ISA holders and managed fund investors whose mandates track the Nasdaq 100. The index inclusion mandate removes all discretion. Retail investors, punters, who buy SpaceX on IPO day believing the hype. Historically, triple-digit price sales companies correct painfully when the first earnings disappointment arrives. The fast entry mechanism does something structurally dishonest. It severs the link between price and value at the moment of listing. Normally, index inclusion requires a seasoning period. This is during which the period discovery happens and fundamentals are assessed. Fast entry eliminates that. The passive investor is therefore paying not for assessed value, but for hype-priced scarcity. Friar's verdict. Starting, of course, with fundamentals. Easy answer. Fail. Triple-digit price sales on a capital-intensive business with unresolved XAI drag. Absolutely not a chance. Signal stack, no signal. We wouldn't even look at the signals anyway because fundamentals are a fail. There's no duration available. The IPO hype thesis has a 15-day mechanical driver. The fundamental rating thesis, the one that would justify 1.75 million, requires years of earnings delivery that we simply cannot verify from the prospectus alone. Friar thinks he's fairly well covered with his 15th of January 2027 QQQ put, and will certainly be keeping an eye on a bear put spread on SpaceX at some stage not too long after listing. What Friar will be watching, the post-IPO strategy. June 11th to 12th, 2026, expect SpaceX pricing and first trading day. The 15-day fast entry clock begins. Mark the 29th of June in your calendars as the earliest date for mandatory ETF inclusion. Watch the SpaceX price action in that 15-day window. If forced buying drives a significant gap up from IPO price, that is the premium we may eventually be positioned to capture on the way down. QQQ overhang, monitor for forced buying, price distortion in QQQ itself. So Friar's January 25th, 27 put leap remains primary doctrine compliant bear expression. The SpaceX inclusion is net bearish for QQQ on a medium-term basis. It adds a high multiple pre-earning stock to an already stretched index. Post-inclusion price discovery. After the forced buying wave exhausts, approximately late June to mid-July, watch for institutional distribution. If SpaceX insiders and early venture holders begin selling into the ETF-driven demand, the price support evaporates. The first quarterly earnings miss after IPO is the potential bear put spread entry trigger on the SpaceX directly. The historical analogy. No company with a triple-digit price sales ratio has escaped a bubble bursting event since the mid-1990s. Through the internet, genomics, clean energy, EVs, crypto. The same arc, the same psychology, the same eventual gravity. SpaceX is an extraordinary business, but it's not exempt.